Imagine actually building the infrastructure for the sci-fi future we all dream about, right? We're talking next-generation spacecraft, microgravity manufacturing, and combat-proven autonomous systems. It sounds like something straight out of a movie, but for Redwire Corporation, it's literally just another day at the office. Welcome to the Edgar Brief. Today we're cracking open the Q1 2026 10Q and a recent May 8th K filing for Redwire, trading under the ticker RDW. We're going to translate these complex legal and financial documents into plain English to see if their space-age tech makes for an earth-shatteringly good business.
But before we blast off, take a look at this number, $350 million. That's a massive equity offering they just filed for on May 6th, and it really highlights the harsh reality of funding space-age technology. We're going to unpack exactly what that means for the company's survival in just a bit. Quick note before we jump in, though. We are independent, not SEC-affiliated, and not financial advisors. We use AI to help summarize these filings so errors can happen. Always verify on sec.gov before making any money decisions.
Okay, here's our roadmap for today's explainer. We'll cover the business model, the scorecard, the moat check, reading between the lines, red flags, and finally, the bottom line. Let's get into it.
Section 1. Business Model. Space versus Defense Tech.
So Redwire kind of splits its personality into two distinct halves. On one side, you have the space segment. They're selling the picks and shovels for the new space rush, doing everything from commercial space hardware to microgravity tech that lets you manufacture things weightlessly in orbit. Then on the other side is their defense tech segment, which focuses on autonomous drones and specialized sensors. Basically, they make their money by securing government and defense contracts. Now, think of these contracts like a high-end corporate catering gig. It's incredibly hard to pass the security checks to win the job in the first place. But once you're the trusted caterer, well, that revenue is incredibly sticky because the client absolutely hates switching vendors.
Section 2. The Scorecard. 2025 versus 2026.
So, do the real cash earnings match the cool factor of their technology? Check out this revenue growth. More dollars are definitely walking in the door. They jumped from around $61 million to about $97 million. On the surface, you'd think, wow, the rocket is lifting off.
But then we hit the operating loss. This metric asks a really simple question. Is the actual business profitable before taxes and interest? And the answer here is a loud no. Their operating loss absolutely exploded, from a somewhat manageable $14 million to a staggering loss of nearly $70 million. If we're putting a label on this business right now, it's a cash-burning hare. They are sprinting incredibly fast on revenue, but man, they are bleeding heavily to do it.
So the absolutely crucial question is, how long until the lights go out at this burn rate? Let's check the balance sheet. Right now, they're sitting on about $145 million in total cash. Against that, they've got roughly $83 million in net long-term debt. But here is the kicker. Their net loss for just this 3-month quarter was a brutal $76.5 million. You don't need to be a math genius to see that if they burn $76 million a quarter, that $145 million in the bank, it won't last them till the end of the year without some sort of lifeline.
Section 3. The moat check. What protects Redwire?
Now, you might be wondering, if their financials are this strained, why can't a competitor just crush them tomorrow? Well, because Redwire's moat is built out of thick red tape and highly specialized patents. Their microgravity capabilities and combat-proven autonomous systems act like a giant toll booth for orbit. To compete with them, you don't just need better engineers. You need years of combat testing, classified clearances, and incredibly trusted relationships. That creates a massive barrier to entry.
Section 4. Reading between the lines. The acquisition cost.
Digging into management's discussion and analysis, we can see exactly why their expenses exploded this quarter. Honestly, it's the cost of buying growth. A while back, Redwire acquired a company called Edge Autonomy to boost that defense tech segment. And sure enough, in Q1 2026, that acquisition added an impressive $36.4 million to the revenue. But reading between the lines, that same segment posted an operating loss of nearly $47 million. You see, buying a company creates a sudden, exciting spike in revenue, but it almost always brings a crushing wave of integration costs. They are paying heavily right now just to digest that acquisition.
Management absolutely knows the clock is ticking on their cash. In February 2026, they scrambled to execute a debt refinancing maneuver with JP Morgan, basically replacing their old debt with a new $90 million term loan. Think of it as a standard business loan with a set repayment schedule. But the key here isn't just the money, it's the timeline. They pushed the maturity date all the way out to May 2029. They are frantically buying themselves financial runway to figure out these integration costs before the big bill comes due.
Section 5. Red flags, dilution, and weaknesses.
Okay, Remember that $350 million figure from the very start of the explainer? On May 6th, Redwire filed an at-the-market, or ATM offering, for exactly that amount. To put that in perspective, think of an ATM offering like a company setting up a lemonade stand directly inside the stock market. Whenever they need cash, they just pour new cups of stock and sell them to passing investors. It's a great way to raise cash, sure, but every new cup they pour slightly waters down the value of the lemonade everyone else is already holding. That is massive potential dilution for existing shareholders, and it's aimed squarely at fixing that cash burn we talked about earlier.
And then there's this quote, literally buried in the risk factors. We have identified material weaknesses in internal control over reporting. Investors may lose confidence in the accuracy and completeness of our financial reports. Guys, this is a giant red flag. It essentially means their internal systems for tracking their own numbers are flawed. If management can't even trust the calculator they're using, we have to look at all these figures with a very healthy dose of skepticism.
Section 6. The bottom line.
So what does this all mean? Redwire is a space infrastructure builder with incredibly sticky moated technology, but they have a terrifying margin of safety right now due to that heavy cash bleed. In the next filing, you need to track 3 exact things. First, their Q2 cash burn rate compared to that $145 million they have in the bank. Second, keep a close eye on the pace of shared dilution, like how fast are they actually pulling the lever on that $350 million ATM. And third, watch for any solid proof that the edge autonomy integration is actually moving toward profitability rather than just dragging down their margins.
Will Redwire's space-age revenue growth outrun its earthly cash burn? That is the multi-million-dollar question we're left with. And that's your Edgar brief on Redwire. Remember, this was a translation, not a recommendation. Read the original filings on sec.gov if anything we talked about today piqued your interest. Thanks so much for being with us. We'll see you in the next filing.